I think people at some point in their career, they get better at understanding certain patterns that matter, such as a congestion box, right? You could draw that in there and say top of the range, bottom of the range. And at some point early on, you understand that. And then the word breakout comes to mind. We're going to break out through the top or break out through the bottom. Now, you should know and understand the anatomy of a breakout. Like there's always open, long, and short positions um, every single moment. There are people long and short all through here for different reasons at different prices and everything else, whether you are or not. And it takes an imbalance at some point, the tipping point, when there gets to be too many shorts. We know shorts equal what? Future buyers, FB. Future buyers is what creates upside. Future sellers creates probability of downside. So shorts has become future buyers. What do longs become? Future sellers, right? This is what you're trying to track. If everybody knows the buyers and sellers, like on your price ladder, everybody knows that. It's not going to be an advantage or an edge if you know something everybody else knows. But not everybody knows other people's positions. So you're looking for longs and shorts, certainly a sample size, and then you have to compare them to each other. It doesn't do you really much good to know how many shorts there are because the number in and of itself doesn't matter unless you can compare it to something that relates to it to find value. So if you get 100 shorts, let's say, that doesn't really matter if there's 100 longs, right? There's no imbalance. But if you have 30 shorts and 5 longs, now we're talking. That's an imbalance. Even though the number is smaller, it's showing more value based on this relationship is more important than this relationship. So 30 to 5, if it's a sample size, again, if the 30 are the number of shorts and the 5 is the number of longs, then we take it back up to our legend. And what do longs equal? Future sellers. What do shorts equal? Future buyers. Okay, we got more future buyers than future sellers. The probability of upside is higher because what do you need to go higher? Not just buyers, future buyers. Future buyers that outweigh future sellers. That's another relationship that's important. If you know how many future buyers there are, it's important to know how many future sellers there are. You could have 100 future buyers, but if you have 100 future sellers, balanced. You have 30 to 5 imbalanced. So it's important relationships. Generally, the value of anything is found through comparing it to something apples to apples. The value of a plane ticket, it's cheap because compared to all the other carriers, it's the lowest. This guy is um, ugly because compared to all the other guys in the room. So it's always compare, contrast. A really important technique that we've always used, and people ignore it. It's funny. People open up trading accounts, they get in this business, and they ignore the concepts and the techniques and the tools that they've used to value price their whole life. And what are you doing in trading? Valuing price on the fly. So now look at this right in here. You're starting to set up a opportunity to have less people long, 37, and more people short. Now that's a 60-minute, what we call OPP, other people's positions. This guy over here is over the last 2 minutes. Now, both are important. What do you want? You want more shorts or less shorts if you're long? More shorts or less shorts? Everybody should scream more shorts. More shorts equal more future buyers. You need future buyers if you're long. Hopefully you're long because you think it's going up. So if you're long because you think it's going up, you need future buyers and many, many more future buyers for the price to actually go up. How do you get future buyers? More shorts or less shorts? More shorts. If you agree that shorts equal future buyers. All right, so now we go to a breakout. We started this by saying it's easy, should be easy at this point to be able to identify a congestion area And it's good that most of the rest of the world identify this congestion area also. You want other people, in this case, to be apprised, to be to see the obvious, because you know that shorts are going to be nervous above that yellow line, longs are going to be nervous below that yellow line. So when this is a case where it actually works to your advantage when you see something most of the rest of the world sees, because you want them to get anxious. You want them to reach, you want them to chase. So if we anticipate, they're anticipating this too. But we're trying to get information. The edge is getting information of timing better than them. And so if you take a look at these numbers, you take a look at these numbers, it's a sample size and the relationship of what? Longs versus shorts. And if we take the slider over here, and you could see that's a breakout. All right. It's easy to say, oh shit, I should have bought it. When could you say that a little tighter? When can I get in before it becomes obvious to have gotten in? And if you look at a big jump happens right here, oops, right here in these numbers, 40 to 34, big jump, 40 to 60, and then it rallies. So you really get a nice spread between shorts versus longs. Remember what you want if you're long? More shorts. And so if I just slide this, I want you to keep an eye on this number. Let me bring it back. Keep an eye on this number right here, 46. Do you want more longs or less longs if you're long? Hopefully you say less longs. You say more shorts and less longs if you're long. Watch that number 46. It shrinks. You want it to shrink to create the continuation of upside. So the breakout does you no good unless you could time better locations to enter, either on the right side, which in this case would have been the long side, or not on the wrong side, which would have been short, and then you would have got run and stopped out, or certainly squeezed, like all the other shorts in this area would have. Go back to what we said at the beginning. In any congestion box, there are open positions at all times. They're changing. When you get an influx of shorts, you don't get that influx of longs. That creates the possible imbalance of more future buyers than future sellers. That's the dynamic needed, the price of anything in order to go up. No matter what it's the price of, it needs that in order to rally.